So, welcome back here from the first coffee break. Yes, we are covering a number of real relevant asset classes here on the conference, and of course, we pay great attention here to private equity as an asset class. It has been one of the dominating alternative asset classes here in the portfolio of German institutional investors in the last years, and our annual investor survey always documents that 85% of all participating investors are invested in private equity. And that's on the one side a good sign, on the other side also a bad sign, because there has been a success story, and there's of course expectations from the investors. How does the success story continue? Will it continue? And in particular, as there were some problems in the last years, lack of exits and so on, it's now the question here, and we have a really distinguished panel to discuss what are current trends in private equity. We have low valuations, is now a good point to invest. What are possibilities to have amendments or improvements on the operational side? And I'm really looking forward to this panel. It's great that Laura Merlini, Managing Director of the Kaya Association, is going to moderate the panel. We have a long-lasting partnership with Kaya, and I'm really happy that she's here today and also moderating the panel. And now I can hand over to you, Laura. Thank you.
Thank you. We are also pleased to be partners in crime for this event, and definitely talking about private equity is essential. I say essential because we are at an inflection point. We've seen that following years of inflation, higher interest rates, challenges in the market conditions. We see what Bain & Company is defining private equity in 2025, the year of a partial exhale. While we say partial because there are signs of hope in the deals rebounding, in the number of exits increasing, and obviously the market conditions improving. Nonetheless, we have to say that fundraising remains a little bit of a challenge, mostly due to the LP liquidity constraints. So we are definitely going to tackle many of these aspects. So the first one is definitely a section on the regional perspective, thanks to our distinguished speakers coming from all over the world. We are going to tackle the operational improvements. We are going to address also how the macroeconomics is affecting the industry, because private equity is no longer an asset class, is an industry. And definitely we are going to answer this philosophical question if the current valuations allows us to enter the private equity markets. So we will definitely start with excellent speakers. Victoria Baker-Dewey, Managing Director and Head of Private Equity Fundraising in MEA at Goldman Sachs. Welcome. Praneet Garg, Managing Director at Asia Alternatives. Yannick Huneke, Member of the Board at Deutsche Beteiligungs AG. And Louis Smith, Managing Director of Private Equity at Apogem Capital. So I would start with you, Louis. It's very important. What impact has the overall uncertainty and market volatility had on your market segments, and what are some of the risks you're mostly concerned about?
Sure. Well, maybe to start, I'll just frame where we focus. So we are a U.S.-focused alternatives firm. We manage about $40 billion, roughly split across private equity and private credit solutions. I focus on private equity. But as a firm, our point of differentiation is within the U.S. lower middle market. And so to us, that frequently means that we are investing in different ways across the capital structure in businesses that are often owned by families or founders and represent the first institutional capital opportunity in a business. We've been doing this for over 25 years. When I think about the current environment, there are obviously a number of risks and challenges. From our standpoint, though, it's actually proven, I think, the strategy to be quite resilient. When you look at where we spend our time and where we build our portfolios, we've actually seen tremendous resiliency in the returns as well as in the liquidity profile over the past 2.5 years in an environment that's been very challenging for private markets. And I think it's because of this lower middle market focus. There's been, approaching $1 trillion of dry powder raised for US buyouts alone. That predominantly sits above where our strategies focus, which means in challenging environments, there's a series of structured value creation initiatives that managers can do to grow regardless of what's going on in the macro, and then sell up market, into the dry powder that's been raised. And our observation has been that larger private equity firms, while they're very cautious, in the new rate environment, a lot of macro uncertainty, they will still lean into high quality businesses. And unfortunately, that is frequently companies that reside in these portfolios.
And Victoria, are you seeing a shifting of preferences in LPs?
Yeah, so quick introduction, Victoria Baker-Dewley. I lead our capital raising on the private equity side at Goldman Sachs Alternatives. Maybe just to also put in context where we sit, so we have around 500 billion in alternative assets. Around 200 billion is within private equity, and that's split between two core businesses. One is directly investing in predominantly different segments of growth and buyout. And then the second is partnering with other GPs and investing across primary, secondaries, co-investments, and GP stakes. So that just kind of gives you the purview from which we sort of see the current environment. And I would say from a kind of interest perspective and what we're seeing LPs focus on, I think, since the big increase in interest rates since 2022, clearly there's been a lot of focus in trying to get back to regular levels of deployment within private equity portfolios. And so clearly a core focus there is, revisiting buyout and focusing very much on that as the core allocation. But clearly secondaries has become an important part of that discussion. One part, of course, to create diversification within the portfolio, but also because of this liquidity situation, which is impacting not only LPs, but also GPs in turn, because the LPs are being impacted. And so that's really driving interesting opportunities within the secondary space. But one thing I would mention is that I think in the most recent period, and we should discuss the exact current environment as a little bit of a pause, but we have seen a bit of a revisit to growth equity. And if I think about how the LPs that think about this is really, if you think about your asset allocation from a more holistic perspective, so really thinking both public and private markets, you'll be sort of seeing that actually your tech exposure in particular is very concentrated and not growing as highly as you would like, because ultimately these high growth stocks are not making their way into public markets anymore. So we have seen an interest from LPs to really revisit the growth equity, the case for growth equity, particularly in light of lower valuations since 2022, capital formation being quite low. I would say the most heavily impacted segment of the market has been VC and growth equity in the recent period. And then, of course, this rationalization, because businesses really haven't been able to raise capital to the same extent. So they've become far more disciplined in their business models, and we think the quality of business has improved. So I think that's kind of the pivot we've seen, sort of buyouts, secondaries, and then moving more into growth equity in the most recent period.
And the unintended consequences of the great convergence between public and private markets.
Exactly.
Yes, which is fascinating. But can we jump into Asia, Praneeth, and understand a little bit what's happening? Because you have worked extensively with mid-market opportunities in India, Japan, and China. So what are the underlying factors and key trends shaping this new investment opportunity in such an energetic continent like Asia?
Thank you, Laura. Just as a way of quick background, I'm a partner with Asia Alternatives. We were established about 20 years back to be specialists in Asia and specialists in private equity. So we only invest in Asian private equity. In terms of the backdrop for the opportunity set in the Asian private equity market, I would say there's a confluence of 4 factors which are making the investment outlook in the next 10 years pretty attractive for Asian private equity. Those factors are essentially attractive demographics in a fast aging world. One of the fastest growing region economically in a world which is slowing down. Scale, something we don't talk about, but I'll talk a little bit more about where is Asia in scale and why it is difficult to avoid Asia on the world stage as things stand today. The last piece is structural transitions. So 3 of the countries that Laura mentioned are going through deep structural transitions, which then allow for private equity to be the transition capital. So very quickly, if I can walk through each one of them, Asia has 4.5 billion people, but more importantly, 35 to 40% of the global workforce resides in India, in Asia, right? That's pretty stellar. In the next 10 years, from an economic growth perspective, 50% of global economic growth will come from Asia. Now, when I talk about these 2 things, I could have made this argument 5 and 10 years back also, right? Asian demographics were good, the growth rates have been strong, but what is different this time is scale. What do I mean by scale? Today, 3 of the largest economies in the world are Asian, which is China, Japan, and India. So we are talking about 3 of the largest economies in the world. So when you talk about demographics growth at scale, it means a lot. The last piece is, as I mentioned, structural transition. Each of these 3 countries are going through a deep structural transition once in a generation. So China is moving from an externally dependent, investment-led growth model to a more internally focused domestic growth model. That allows for opportunities, investment opportunities to arise in deep innovation as well as structural opportunities like buyouts that Victoria talked about. Japan has been a stagnant country for 3 decades, and finally it's breaking through that stagnation and is rejuvenating its economy by digitization and seeking to kind of do productivity gains, and that is allowing a lot of mid-market opportunities in a 3rd largest economy in the world, similar to what we was talking about in the US market. Talking about India, the last piece, which is India has gone through a deep structural transition in terms of reforms, which is then allowing India to become the fastest growing large economy in the world for the last 5 years. And in the next 5 to 10 years, India will continue to become one of the fastest growing economies. Then that provides growth opportunities. In closing, I would say it's interesting that, we talked about exits. Asia markets are not a monolith when it comes to exits. So exits are actually relatively slow in the largest economy of Asia, which is China, but have been very strong in India over the last 12 months. So India had the most number of IPOs in 2024 in the world. India was the 2nd largest IPO market capital raise after US in 2024. Japan, the exits on secondary and trade sales have been very high. So all I'm trying to say is that, Asia has diverse flows of exits, investments, and fundraising, which makes it a very attractive destination over the next 10 years.
And it's also consistent with the trend of the global south, meaning
Yes.
LPs investing locally, right?
Yeah. Just a quick comment on that. Obviously, Asia currently has 60% of global supply chains. Now, there is a push and pull to restructure these, but a large part of this will be in Asia. Whether it is in China, a lot of that will move to Vietnam and India, but a large part of that will still remain in Asia.
Thank you so much. Now we do another geographic tour in Germany, exactly here at the heart of productivity. So we still cover the mid-market segment. And for you, Yannick, how are these mid-market leaders with specialized expertise positioned in this particular moment with lower valuations?
Thank you, Laura. Just to start with what we do at DBAG, we are a mid-market private equity firm since about 55 years around, have done more than 300 transactions, platform transactions in the German mid-market. Therefore, we know the market very well. And I think we have done about, in the last 5 years, about 100 add-on acquisitions. Coming to the German market is huge. We have about 85,000 family-owned mid-market companies which are relevant to us in Germany. And about 11,000 companies face a succession in the next couple of years. That has been said already 10 or 20 years ago, but it's happening. We see a lot of families looking for successions. We see a lot of deal flow from these areas. And in Germany, you find a lot of technologically leading companies, world market leaders in what they do, often very technical, technologically driven. And currently, the market is, from my perspective, quite attractive because compared to 2022, we have a valuation discount from approximately 1 to 2 multiple points. So you get very well positioned companies which are world market leading at a discount compared to high times of 15 to 20%. Besides that, a lot of these mid-market companies offer a lot of value creation potential. As said, they are very technologically driven. Often it helps them to support them in operational excellence, also in developing further digitalization. And therefore, we see a lot of prospects for private equity investments. And from a top-down view, if you look at the German market, about 80 billion private equity has been invested in German companies. If you compare that to UK, that's about, in UK, about 150 billion is invested in this market. And on the other hand, if you look at the Netherlands, it's about 40 billion. So obviously, Germany is a larger economy than the Netherlands by far. And even compared to the UK, the investment in German private equity is comparably low. So it's an underpenetrated market, and there's a lot to do. And it helps to have home buyers here. So you need to be around here, especially in the mid-market at least, yeah, and have close contact to entrepreneurs in Germany. And I think that that's the way. And as said, there's plenty of deal flow for reasonable prices. And we are currently in a situation, we now have a government again, yeah, since yesterday at least. And the investment program in Germany with those 1,000 billion euros is similar to a Marshall Plan. Yeah, that is substantial. And especially if you're looking at various specific sectors, everything which is related to infrastructure, energy transition, etc., there are very nice growth cases which are now supported by this investment program.
Oh, that's good. So thank you, and also good luck with the next phase. Now we are going to talk about something which is tied up into the regional view, because it's really a big change that it's happening in the private equity industry. What's happening is basically, if you read the reports from McKinsey, 61% of the returns of the private equity were to be ascribed to the financial engineering, so the leverage and the multiple expansion. But now we are living a paradigm shift where operational improvements are key and are the key driver and value driver for the development of this market. Luis, again, starting with you, because definitely we need to be vocal. Do you see a before and an after? Could you perceive this shift?
I think it depends on what part of the U.S. buyout market you're thinking about. I think certainly for larger transactions reliant on leverage, the LBO math looks a lot different today, than it did prior to the rate hiking cycle beginning. What I think is obvious is that you have to find businesses and make them better. I mean, you have to invest in professionalize, scale, and ultimately grow the earnings power of companies to ultimately generate a strong return. And when I think about where we focus our time and where we build our portfolios, we like the lower middle market because across cycles, I mean, there's obviously a tremendous amount of uncertainty in the environment broadly, which we can talk about. But when we think about the first institutional capital opportunity, over cycles, you've seen 300 to 600 basis points of outperformance depending upon the time frame compared to larger parts of private equity, just in the benchmark data, because there's a consistent opportunity to buy a business, professionalize it, and then capitalize on the scale and that one-time value creation opportunity that goes along with executing that strategy, selling it up market. And it doesn't matter quite so much what's going on in the macro, because those are things you can control. In today's environment, for example, if you think about just the tariff situation, which to us, just as an aside, when we look at our portfolios, we really think about it, roughly 70% of what we do is more services oriented. And again, these are smaller US focused businesses operating in domestic markets. So less impact directly, from the potential tariff regime. We're more concerned about demand destruction broadly and what that means, if we move into a recessionary environment. But this has been an incredibly resilient segment of private equity over multiple cycles. And what that means is when you're buying a small business operating in a large market, there are multiple ways to win, which is translated to strong results over time, which is why we have focused on this market segment, for over 25 years.
And how you can make sure to select the best manager?
It's hard. A lot of what we do is first and second time institutional fund investing. We've committed to over 100 of those funds over our track record, and the returns have been strong. And so we have a unique set of diligence processes and tools that we use to self-select into what we believe to be the best managers. And we really do that by combining skill sets that are focused on evaluating people, teams, track records, in addition to direct asset level underwriting, looking at deals alongside private equity firms, from a co-investment standpoint, going deal by deal with folks even before they raise a fund. That enables us to take a holistic view and we believe select into the best managers.
It's more of a journey.
Yes, certainly.
So Yannick, going back to what you were saying about the digitalization, you were alluding to that in a moment ago. So how are you helping portfolio companies to balance this traditional mindset with these innovations that are happening in the industry in order to really create operational improvements?
Actually, on various fronts. On one hand, we invest in companies which drive digitalization. We invested in Unity and Freiheit.com, companies which help mid-market companies to digitalize. And we also use them and help our portfolio companies to develop further. Then we have traditional companies, for example, a company Dantherm, they are in mobile climate solutions active, and we acquired another company which is also in the same segment, complementary, but has a distinct digital sales channel, and Dantherm was a pure offline business, so we combined it with an online business, and that bears a lot of fruit and synergies on the sales side. So this combination of traditional businesses with modern sales channels has proven to be quite a good value driver. And then we support our companies in getting more efficient. That is also due to a portfolio company we own. It's called Solvares. What they do, they develop algorithms for route optimization, and they also optimize appointment schedules for service personnel, etc. And this is used in portfolio companies to make them more efficient. And last but not least, so on our side, we developed AI software together with Freiheit.com, the first portfolio company I mentioned. And we developed a software which supports us in structuring our deal sourcing process. As I mentioned before, we have about 85,000 relevant companies, a lot of successions coming up. And we trained our model, AI software is continuously reading out Bundesanzeiger and other reliable sources about information and combines that with age information we get about owners, etc., and combines this with our CRM information and helps us to prioritize our deal sourcing approach. So there we also use technology for ourselves.
And also you as a member of a board, I understand that governance is a part of these operational improvements and creating some alignment between the underlying companies, and yeah, it's vital, right? In terms of governance uptake. the governance model that you implement within this business and the operational improvements is, I guess, it's critical as well.
Absolutely, yeah. You need to make sure that the right persons are at the right position in the company. And we start on the advisory board level. So we look that we have the appropriate persons who can drive technological change within the company, and then make sure that we have on C-level and below C-level the right persons to drive this further.
Yeah. Praneeth, can we jump into these operational improvements and innovation in Asia? What's happening in
absolutely. Absolutely. Once again, I will just with a caveat that there is no one Asia, but let me quickly give you a sense on what is happening on the operational improvement side. So talking about Japan, I'll just pick a leaf from what Yannick mentioned about Germany. I mean, similar economies, pretty large, deep mid-market, haven't digitalized substantially over the last several decades, now getting forced into digitalization. One other data point I'll share with you, about 70% of CEOs in Japanese mid-market have an average age of 69. So somebody needs to provide a succession plan. And private equity is well placed for doing that because these businesses have been run like a family business. So talking about operational improvements, some of it is super low hanging fruit in a market like Japan, where you just take a very well established market leading business, not being run effectively. So low hanging fruit is just very simple. Institutionalize it, put on a management team. What is different about Japan and Germany, if I may, is that Japan actually is the thriving capital markets. So once you institutionalize these businesses, you can actually have a big arbitrage available on the stock market to sell these businesses. So that's Japan for you. China is going through a totally different cycle. Chinese economy was growing at 8%. Some sectors were growing at 20%. Companies were growing at 30 to 40%. So nobody cared much about operational improvements when the growth is so strong. What has happened is the economy has slowed down, and as a result of it, people need to find more levers. So private businesses are coming to private equity for help in terms of what? In terms of global expansion, in terms of, again, institutionalizing from an entrepreneur-run organization to, moving to be more institutional. India is a slightly different story. Growth is still very strong. Most of the value add is still happening on, again, institutionalization, but making the governance framework such that the companies can go IPO. So I think that's where the hotbed of operational improvement in Asia is.
Thank you so much. Now we need to take an helicopter view on the fundraising conversations between LPs. So you have a global perspective. So maybe can you detail what's happening and what keeps LPs awake at night in the fundraising activity?
Yeah, so if I were to sort of highlight 3 points where I think LPs are spending most of their time. So clearly, track record will continue to be fundamental to all decision making. However, I think past performance is clearly an important indicator, but I do think people are digging far more into how that value was created in the past and to identify whether the model is replicable. So you basically want to know, is this something that can be done on a repeat basis? The type of things that we see people looking at there really are very much around the value creation type of model setup. Clearly, there are network effects that are beneficial, but also operating advisors and how they support the portfolio companies. Is this a collaborative model, or is it something that's kind of a bit more forced on the companies? So type of model is one element. How well resourced is that model? Because ultimately, private equity is turning into a bit of a sort of war of resources. So it's important to make sure these teams are well resourced. The skill sets that they have, are they complementary to the management teams? Are they complementary to the investment teams? Are these people that they would like to work with? And then ultimately how they're compensated, because that ultimately is incentivized people to drive that performance. So I think higher scrutiny around the value creation model is definitely top of mind. Second, I would say around fees and the cost of private equity. I think this is one that people like to talk about a lot. What we've seen obviously over the last couple of years, given reduced capacity, investment sizes have come down a little bit. And so maybe if you were eligible for certain discounts and co-investment deal flow previously, maybe now you don't quite qualify to the same extent. So we are seeing some form of consolidation in GP relationships. I think people recognize that they have, particularly those with mature portfolios, they've invested in a lot of managers for a long period of time. Maybe they can consolidate those discussions, and we're seeing that across client types. So not only in sort of the pension insurance community, but also sovereign wealth funds, for example. That's a very good illustration of what is happening in that market, and also wealth managers who are really looking to build out their private markets capabilities, given the sort of popular democratization of alternatives, which is sort of hitting the headlines.
That, but do you see competition for deals between the two legs, the investor, the institutionals, and the private wealth?
It depends a little bit on how the deals are accessed. I think for the time being, wealth managers are relying on other asset managers, and I don't necessarily think the deal dynamics have changed. Clearly, you have seen a professionalization from the sovereign wealth fund side, where they've built out significant investing teams, and so there is some competitive dynamics, particularly those that like governance and would like to be co-underwriting or sole owners on deals. So I think, but ultimately at this point in time, it's still kind of similar players. But this actually brings me on to the third point, is the requirements around accessibility. So how do you access private market strategies? And previously people would just ask you questions like, what's the track record, the team, fees, etc. Now they're asking, what is the format? Can you create a regulatory wrapper? Can you make this evergreen? Can you provide liquidity? Can you provide us with education so we can go out and sell this to multiple people? And so this kind of evolution in what is effectively kind of the evergreen type of solutions and regulatory wrapped solutions is becoming highly prevalent. And this is not just a wealth, sort of unwrapped wealth story, but very much a wrapped wealth story as well. So you're seeing, for example, unit-linked in Europe, DC pensions in the UK, 401k schemes in the US, all of them are trying to achieve the same objectives. And the reason why I think this is important from a performance perspective is clearly how you wrap the investments is going to have some implications for the ultimate performance of the underlying. It's not necessarily only about underlying investment performance, but it's also how you package it.
Yes, so we stay on the how, and it's very fascinating what you mentioned, but also in the regional opportunities. So now we jump more on a macro level. What do you see these regional opportunities, given the fact that you have a global, obviously, overview again? So.
Yeah, so I'd like to say I agree with, that's one thing we all agree here. I think being global, you can agree with everybody on the panel. But, clearly we do think, we do see opportunities globally, US, Europe, Asia, and we're active across regions in different segments of the markets and very much complementary to the rest of the panel. I think it would be remiss to not talk about Europe as we sit here in Frankfurt today. Because ultimately we've been investing in Europe and in Germany for a long period of time, and we have a significant business. And I would say it's not only kind of the relative valuation element that is interesting, because clearly there is that element, particularly versus the US market, but clearly there's also very highly skilled, excellent management teams that you can find in a number of these European businesses, and who are highly receptive to working with partners and private equity in order to drive value creation. And so we're very much focused on a number of these thematics in the European market and in Germany as well, where we have investors locally as well.
And staying in Germany a little bit now with this macro view and the impact of tariffs, how do you see it's affecting your business?
Yeah, that's indeed a good question. And more recently, somebody asked me, what's the impact, and did you calculate the impact on your portfolio? And I think that's a difficult exercise, since we do not know the tariffs yet. Yeah? And that's the first point of it. And I think it's not really easy to say what is the impact on a specific business, because it does not necessarily need to be bad in any case. Yeah? If you have a business where your main competitor is located in China and you are looking at the US market and you don't have a local market participant in the United States, which is often the case in industrial businesses and some technological businesses, then it's about relative performance. And then you even may have an advantage with a lower tariff. Yeah? That puts aside the secondary effects, but they are really difficult to measure. Yeah? So overall, for us, it's what we always do, sit down with the management and discuss with them what could be the impact, yeah? How interesting is the market, what's your view on the demand in the specific market, how is your relative competitive situation, and how you can cope best with it. I think that's the only thing you can do as of now. Yeah? Overall, probably it leads to rearranging of supply chains, which can in some areas also be good. Yeah, it really depends on your specific business and can also offer growth opportunities. So overall, I would say as of now, difficult to assess. Probably over on the macro perspective, not really good, yeah, bad, but what it means for the specific portfolio to be seen. Yeah? And we work to cope with it best. And certainly, I think the investment approach has changed a bit. Yeah? So overall, very global businesses are partly a bit less in favor. Partly we are looking a bit more into business which have more local growth perspectives. And as said, there's plenty to find and to do. Even if the German economy recently didn't grow that much, but there are specific sectors which are growing strongly. And that relates to energy transition, that relates to infrastructure-related things, that relates to other trends where we see growth. And that's what we are focusing on.
And Louise, I think you partially replied to this question at the beginning, but you were mentioning goods versus services, the tariffs, and how this is impacting.
So we've spent a lot of time thinking about where we are impacted or potentially impacted and trying to quantify that. And I think our observation has been, again, coming out of COVID, I think our managers had to react very quickly, to a rapidly changing and challenging environment. And as a result, they have playbooks that they put into place to continue to evolve and capitalize on, an ever-evolving environment. And this has been on their radars for a while. So our managers, when we called them and said, hey, obviously this is now happening, they had plans to mitigate the potential impacts of the direct tariffs. And so, we, again, are more focused on the indirect or secondary impacts that will be something that the collective economy tries to navigate and feel well positioned given that there are multiple, ways to grow, multiple ways to win in smaller businesses, operating in the U.S. Market.
And going back to Asia, how private equity firms in your region are navigating the tension between regional opportunities and the desire to expand portfolio companies globally?
Yeah, just as a way of context, what we do, but generally speaking, Asian private equity, and this is an important point to give the context, despite the fact that Asia, particularly China, seems to be in the center of trade wars, is that private equity firms in Asia for the last 20 years have been largely focused on domestic investment opportunities in each of the big markets, while the economies are driven by, like China has been driven by trade, but most of the private equity investment, even in China, are domestically focused. So if you look at that context, I will agree with my colleagues here, the first order impacts are clearly not there. We have done the analysis. 96% of our portfolio, even in China, is domestically focused. But not to say a big knock-on effect on slowdown of the economy was not going to impact those businesses, right? So clearly, large focus is continue to be built domestic businesses. The second most important factor on regional aspect in Asia is actually intra-Asia trade. So, the fact that these Asian economies can trade within themselves, and China being the big elephant right there, can substantially increase trade within Asia, is where most of the portfolio company activities are focused on, because they are not excluded from the trade tensions, but they have less tension there. The last piece is just the cross-border global opportunities. Select sectors in select countries in Asia are trying to harness global opportunities. For example, India has always been a market leader on IT services, outsourcing related opportunities, but that's so far not impacted by trade because it's services. Similarly, Vietnam and China are trying to build global businesses in certain specific sectors where they have an edge.
That's great. We have abundant 6 minutes to reply to the analytic question at the end. Given what we've analyzed, given the fact that we've just did a tour in different regions, we've analyzed the importance of operational improvements, we've analyzed the effect of the current macroeconomic condition. Is this an opportune moment to enter private equity? Yes, no, and why? Yannick.
Yeah, absolutely. For me, private equity is about transforming. What does private equity do? We transform things, and we organize new governance, have the right people at the right place for the right challenges. We organize successions, that's also transformation. We transform digitalization and support that. We do roll-ups, buy and builds, consolidation. So it's about change, forcing and fostering change. And I think change is needed, especially in a volatile, changing environment. And therefore, PE, as the governance in driving change, is well positioned to cope with these challenges. And I think actually that in certain areas, for example, even ESG, in the private market, there has been much more change and done than actually in the public market because the impact is more immediate. And so when considering that we are in difficult or interesting macroeconomic times, then change and managing change is important.
That's great. And if you think about an adjective to define the private equity in 2025?
Who can, at best, manage transformational processes.
Excellent. So on the transformation side. Victoria, what do you think?
I mean, it's existential for me, so I have to say yes, but it's not only yes because my own personal role, but I would say, so private equity is effectively applying skill, resources, governance models, many of the things that Jan mentioned now. And so I think relatively speaking, if you compare to the public markets, there is a whole toolkit there that can be exploited, which ultimately should serve well in a very uncertain macro environment, because ultimately you should be able to navigate change more than if you do not have that toolkit available. And so I would say yes, for that reason. I think this is the kind of arena in which private equity should be thriving effectively, uncertainty and where change is required, as Jan mentioned. So if I were to give my word, I would say adaptable. Okay. And I say that from both an investing perspective, because ultimately you're looking to navigate this period, and you probably have to make some changes because how you generated returns in the past might not necessarily be the case in the future, but the industry will find ways to generate returns. And then also from a capital formation perspective, it's also adaptable because ultimately there's been a bit of a scarcity in capital from the institutional client base, and so we need to find other investors and other forms of capital, and so we're seeing that the industry adapt to that.
Thank you. Annie?
Well, listen, a lot's been said. I'm not going to repeat all that. Obviously, private equity thrives in the time of transition. It's the best source of transition capital transformation. We truly believe that the 3 large economies in Asia are going to substantial scale transition at scale. So it should be a great time. One aspect I think get missed talking about private equity as we are democratizing private equity is actually the biggest feature of private equity is time horizon. In the period when there is so much volatility, I think private businesses have the opportunity to transform without the noise of public markets, without having the reporting quarterly disclosures. They just can get down to doing and rebuilding businesses and transforming businesses over a 3 to 6 year period. And I think this is the best time to be in private equity because of so much volatility that you need to put your heads down and focus on transforming the businesses.
Thank you, Luis.
So I'll say yes as well, but you have to pick your spots and you have to pick your partners well. So I think there are some segments that will perform exceptionally well in this environment. There are others that will struggle. To us, we believe that consistent exposure to the asset class is critical. It's very, very hard to time private equity, partially due to the duration. And so, we recommend investors maintain consistent exposure. If I had to pick my adjective, it would be resilient. We found that the U.S. lower middle market has proven to be resilient over multiple challenging economic periods, GFC, the COVID blip, and to me, maybe most relevant since the second half of 2022, as I mentioned. I mean, the liquidity we've been able to generate for our investors, along with the resiliency of the returns, I think have proven this is an all-weather strategy that investors should have exposure to consistently in their portfolios.
And I will include myself in the re-answer. I would say yes, but we need to be careful. You mentioned finding good partners, but also for us at KAI, it's important the education. So having informed investor making strategic decisions is key, and the adjective or the substantive will be innovation. And that it's the fascinating aspect of the private equity, that it's constantly evolving. So I wanted to profusely thank our panelists for their insights and an attentive audience. I don't know if we have 36 seconds for a question. Any question?
Yes, indeed. There is time for questions. And you answered a lot of questions, but maybe there are still a few here in the audience. Yeah, could you come with a micro? Hier vorne in der dritten Reihe. Vielleicht heben Sie noch mal eben kurz Ihre Hand, dann findet die Dame Sie auch, genau.
Perhaps it's a too specific question to Mr. Garg. I hope I pronounced it well. Regarding, you spoke about India, China, but less about Japan, because in Japan there happened a lot of regarding the regulation. Also, when we're in Germany discussing of companies have to find a new owner due to the older ones who founded the companies. In Japan, it's much more relevant that this company is seeking for new owners, and also the market is, when you speak about Germany, is less penetrated. When you think of UK, I think Japan have also a lot of hidden champions and is less penetrated by private equity. What do you can say about the Japanese private equity market? It's not easy to find invest as a private equities there.
Thank you for that question. It's a great question, actually. It is not easy to find great Japanese assets. Again, I will take a German example just to kind of explain to this audience. Japan is also a very insular economy. Language is a big hurdle, particularly as you keep going down the stack in the mid-market small cap. So for example, if international firms show up in Japan small cap, the books are in Japanese, everybody speaks Japanese, you have to, so that's one big hurdle. So yes, it is possible to find those attractive businesses. There has been a tremendous corporate governance reform that has been done in the last 5 years on the public market side. So now it has set the tone that governance is the way forward, and private businesses are willing to do that, but it is harder to find. Therefore, I would go back to what Luis said. In a market like Japan, it is very critical to find the local partners who can go and find. One other small data point I'll build on that great question is that I mentioned the average age of a mid-market CEO is 69. They have built this company over 40 years. While they are going to sell out this business, they take deep pride in handing over that business to somebody which will create their legacy in the next 20, 30 years, which is a very peculiar Japanese way. So therefore, relationship building with the vendor, not only for price, but for the vision of that company is also very important. So the contours of doing business in Japan are very different, and you have to have the local nuances to be able to do that. Thank you.
Okay, is there another question? Okay, then a big applause here for the panelists. And now I switch first back to German. Wir gehen jetzt hier in unsere Mitglieder-Slots. Vielleicht können wir eben die Folie zeigen. Und nee, das ist unsere aktuelle, die Folgefolie bitte. Wir haben nämlich jetzt noch 3 Mitgliederslots, die es noch nicht wissen. Das ist auch ein Mehrwert unserer Mitgliedschaft. Genau. Die Mitgliederslots, auf die können sich natürlich immer Mitglieder bei uns bewerben und können dann hier auch auf der Konferenz vortragen. Und hier sehen Sie die 3 Slots, die jetzt laufen. Wie gesagt, Mistral ist gegenüber, Orient ist hier vorne rechts und Okzident ist da. Suchen Sie sich eins aus und nutzen Sie die Chance. Und im Anschluss an die Mitgliederslots ist unsere Mittagspause. Und dann sehen wir uns im Verlauf des Nachmittags hier wieder. Once again here, thank you very much.